All right, I didn't quite get everything. Oops, I didn't want to do that. I didn't quite get everything covered, so I'm going to start right here, and it'll take us less than 5 minutes. So I started to introduce problematic, right? Key, problematic financial institutions. You want to stay away from pawn shops, check cashing outlets because they charge these really high fees. Okay? Number one thing, stay away from them. They charge way higher interest rates than regular banks do. Payday loans, right? Terrible interest rates. Now, rent to own centers. They call it problematic, but I guess this can work for some people. Rent to own centers are stores that lease products to consumers. Basically, you lease them until you make a certain number of payments and then you own them. Now, you probably pay quite a bit more than you would at the store, uh, so that's why they call it problematic. But it does work for some folks. They just have to pay a higher amount. They're basically renting or leasing the products until they own them. All right. What kind of savings plans would we see at these financial institutions? We'd see what we call regular savings account. So now we're not talking about checking anymore. We're talking about savings. All right. Now, regular savings accounts are ideal if you make frequent deposits and withdrawals. Requires little, that should say, or no minimum balance. And it's basically a demand account, but it allows you to withdraw money on demand. The trade-off, again, is you get very low interest, right? If they let you make withdrawals on demand, they can't count on that money to loan out to other people to get their interest. So that's why you would get little interest. Certificates of deposit, often called CDs, is money that you leave on deposit for the stated amount of time. We call it a term. And you would get a specific interest rate. Okay? The maturing date, that's what they call when that money becomes available to you. So you might put your money in, for example, a 3-year CD, and you'll earn, I'm making this up, guys, I have no idea, 3% on your money. Okay, the thing is, if you take it out early, you have to pay a penalty. And there's a minimum amount of deposit. Okay? The trade-offs here are you leave your money in for a specific time, you can't take it out. There's some minimum deposit, but you hopefully get a slightly higher interest rate. Okay? There's money market accounts. They call money market accounts. So that requires a minimum balance, and its interest rate would vary month to month. Lots of times it's tied to the Fed, right? Higher minimum balance required than a regular savings account, yep, and usually a higher interest than a regular savings account. So here your trade-off is you have to put a minimum balance in, but you might get a higher rate, okay? And then you guys, I think, have mentioned U.S. savings bonds. So there's all sorts of different maturity dates, right, for these bonds. And it depends on when it was bought and the interest the bond is earning. So that's across the map, right, all over the place. Some bonds have interest rates that change every 6 months. Okay, and the Series EEs, when they mentioned in the book, must be held for 5 years or a penalty is assessed. So savings bonds can be a place to put your money, and that money then is available for the U.S. government to use, isn't it? All right, so if you're going to evaluate savings plans, where do you want to be, right? What do you want to do with your money? You would look, obviously, at the annual percentage rate. You would look at the compounding, and we've already done some work on that. You'd look at how much liquidity you need. Some of these accounts are more liquid than others, right? You would look at the safety of these accounts. Are they insured by the FDIC? And then you would look for restrictions and fees, right? You want to evaluate all these things when you're looking at savings accounts. All right, what kind of checking accounts do we have? This is the one we're going to have fun with later in this chapter. Regular checking accounts, again, no minimum balance, but they might incur a fee if you're below some certain level. So you really have to read the fine print. Now, sometimes if you have a checking account and a savings account at the same bank, right? If you have enough money in here, they might waive all the different fees. So that's something to think about. Then there's a thing called activity accounts. So for people who don't write too many checks, this might be the place to go, right? No minimum balance, a charge per check written, and then usually a monthly service fee. So you have to compare, right? Then there's interest earning checking accounts. It's kind of a combination here. You pay interest if you can maintain some kind of minimum balance, whatever they decide that might be. And then you could write checks out of it. And that, folks, is the end of the second video. So I want you to complete the homework questions. They come right out of the videos, okay? They're not meant to trick you. And also, you need to complete the Google Forms that I sent you in your email. It's due Thursday night, tonight. All right, if you have any questions, please feel free to email me. Thank you.